It is time to move to our next panel session, which is dedicated to sustainable finance, securing capital in a changing environment. The discussion will focus on the growing trend of incorporating ESG metrics into capital allocation decisions and the profound implications this shift has for both investors and companies. The panelists will discuss ESG integration strategies, new financial instruments, and the implications for businesses that are raising capital. The panel will be moderated by Courtney Fingar, founder and principal of Fingar Direct Investment. Courtney, if you would like to take the stage.
Thank you very much. I'm absolutely delighted to be involved in this summit, and I would like to congratulate, of course, the organizers on the fantastic job. It's really not easy to bring together such a high-level gathering of people from all around, and it's always the first such summit, so we're looking forward already to the next one. And I'm really happy to lead this panel, but this panel in particular, that's because, you know, we're talking so much about the importance of ESG, the need for it, but also the practicalities. And I would argue that given that the banking and finance sector is really what greases the wheels of every other industry, we really can't have any meaningful application of ESG unless the banking and finance industries are fully on board and actually helping us get there to the goals. So we're going to talk a bit about what that looks like, what it means in this region, but also in general. It's quite a lot, you know, to chew on really, and we will try to strike a balance of not getting maybe too far into the weeds, but make sure that we hit all the important notes. We're also that panel that is in the lunch hour slot now, so no pressure to the panelists, but we really need to give you something engaging to work with since we were standing between you and your lunch. So that's enough out of me, and we will go ahead and get started. And I think you've seen, I won't spend time on, you know, too many of the bios and whatnot. I want to start with Balkans, if I can, and just give us sort of the headlines here. First of all, why does it matter? Where are we with the industry in terms of ESG? And how do you really put it into practice, for example, in your own organization?
When we analyze why banking as an industry is important in the intermediation when it comes to ESG, maybe one figure could demonstrate it well, that if we see the funding of the corporate borrowings in Europe, it's approximately 70% coming from bank lending. As opposed to, for example, the US, where it's almost the other way around, so it's around almost 80% of the funding is provided through capital markets. That demonstrates very clearly why the role of the banks in ESG are crucial. But what I think is important to emphasize here is that certain clarity must be provided. So recently and today on many discussions, we have heard that there are a lot of initiatives around. There are a lot of discussions on this topic. But I think, as for all other domains, the clarity and the clear understanding and interpretation of in the same manner for each stakeholder is critical. And in order to achieve that, I think we should follow this evergreen principle of keep it simple. So I think that would create clarity among the stakeholders. When it comes to banks and when we are analyzing the transition towards full implementation of ESG in the region, I think it's important to establish credibility. And as for, again, for many other fields in the economy. And how can we achieve that credibility? If we have clear definitions, and then we can measure those, we can report those, and we can transparently demonstrate to all our stakeholders how does it look like. I know I'm a bit general, but intentionally, because there are a lot of aspects which we can dig into that deeper. Why I'm mentioning it? Because the enthusiasm is definitely important, but not sufficient. So banks need to ensure a few things when creating and building up this credibility. There are certain, I would call, homeworks on behalf of the banks. Their internal homeworks, how they act outside to their clients. And there are two other stakeholders which I would highlight as well. The supervisory authority in each country and on supranational level as well, and the local legislative environment, and again, some supranational legislation. Maybe in the first round that we can just talk about what banks should ensure in-house. I think that's very important that they have a clear connection how the ESG framework fits into their overall operation. When I mention about clear standards, I would make an analogy, probably that's the best, towards other regulatory requirements. So in terms of capital adequacy, solvency, all the Basel requirements, which are very important regulation to the bank, it's very clear how do we define capital adequacy, certain definitions. It's very clear how do we define liquidity, how do we measure it, how banks are setting targets for it, how the regulators are setting targets for it, and how the banks are going through the way to achieve that. Similar transparency must exist in the ESG domain to make it in a credible manner, so that everybody is having on the same platform what the requirements are in all pillars, what the definitions are, how you ensure that the data that is provided either through banks or to the banks from their clients are independently measured and verified, and based on which banks are processing it further. So these are just the basic pillars initially, and I think that we will continue on some other.
Thank you. That's a good way to start us off and get us sort of down the right road. I'll turn to Metodio now. Tell us, why do you think that ESG is important? If we broaden it out to the Western Balkan economy in general, why does it matter, not just for banks or for institutions, but to the general economy? And what do you see are the main opportunities, challenges, and risks associated with the pursuit of ESG standards?
Thank you, Courtney. ESG plays a significant role in the development of the Western Balkan economy, but not only to the Western Balkan economy. There are many drivers and many challenges on the way on, because we have also discussed about the topic is relatively new maybe for this part of Europe. I would start with one of the challenges that I see on the way, and this is the level of awareness and knowledge in the economy about the topic. Unfortunately, there is insufficient knowledge of what ESG stands for, what does it mean, how it is being introduced, what kind of benefits does the economy have from introducing and practicing ESG. And I think events such as this one, or even furthermore, events later on organized by the local Chamber of Commerce, can maybe reduce this gap of what actually ESG stands for and what are the opportunities to the local economy, because at the moment it's still being considered as something which is an obligation, something which is cost, something which is burden to the businesses, rather than opportunities that can derive out of it on a long run. Talking about the drivers, there are many drivers that I can think of, and I could start with the fact that the more you invest in technologies which are driving to decarbonization, energy efficiency, resource efficiency, waste management, electromobility, the more the companies are actually reducing their operative expenses, improving their competitive edge, and then this will eventually result in market resilience, this will result in better financial performance of the companies. So there is a direct connection with trying to constantly invest in being better in the process of reducing your negative environmental footprint and in the path of decarbonization. Next in line with that I could also mention is the management of risks. So as long as we introduce ESG, we have a better risk management in terms of managing and moderating market risks, climate-related risks, supply chain risk, reputational risk, which eventually transfers into better competitive advantages of the economy as such. Another challenge that we have, especially in the Western Balkan, is the phenomenon of brain drain. So we have a lot of people migrating this area, moving to Western Europe out of various reasons. And by improving and working on these ESG standards in the economy, by providing equal opportunities, by investing in people, by improving the working conditions, to a certain extent, ESG might also support in retaining talents in the economy, which I would have to say is becoming more and more challenging for this part of Europe. And last but not least is the access to finance, access to investments. The more we see ESG in practice, the more we see favorable conditions for investing, for financing products and opportunities on the markets, and vice versa. We already have as minimum criteria in some of the markets where unless there are minimum ESG standards in place, it's a red flag, it's a no-go for accessing to finance or to future potential investors.
And if I just, as a very quick follow-up, is the access to finance improving, or where do you see that? Is the current general global market challenges making that even harder?
It's a process of evolution, I would say, because in some of the markets, it's not there yet, but I see it more and more happening, and the more and more banks are taking leadership on this end, we could see a transfer to more sustainable development, meaning that the more we close our eyes to unsustainable practices, the less long-term sustainable changes will happen on our markets. So yeah, it's a trend, and it's also a responsibility of the financial sector to stimulate and to drive to these changes.
Thank you very much. I'll turn to Jelena now. In practical terms, what does this all mean for the banks?
Thank you, Courtney. I think that the Balázs and also the Metodie make the good introduction to the topic. But when we talk about ESG topic, I would like to stress and maybe to start that we are all sharing and have the same need when we are talking about this. And these are the needs, the first one to decrease the impact of the physical events, then continuously increasing necessity for low carbon environment, then the need for efficient resource and sustainable economy, and last but not least also the need for inclusive society. And in all these needs, I would say that the banking sector, robust banking sector, as well as overall financial stability, has a key role, I would say, in enabling smooth transition overall economy toward the ESG environment. And from that perspective, financial institutions has a key role in managing risk and raising the funds for sustainable project, especially taking into consideration their unique position in intermediating capital flows through their investment, lending, and advisory role. Beside this, banks also has the technical expertise, I think at the highest level compared to all other stakeholders and compared to, I would say, all other sectors. How to manage and assess, I would say, the risk and opportunities related and connected with the sustainable economy and sustainable, let's say, asset. And creating the framework for the sustainable banking, I think that we should all agree that one holistic approach should be, I would say, implemented, and this holistic approach should encompass several components, and this is measurement, management, monitoring, and disclosure of ESG risk. Practically, what does it mean for banks? This means that three major areas, I would say, is tackled within the banks. First one is the bank strategy and the governance. The second one is banking operation, and primarily the operation related to the clients, because it's our core business. And this is how we are the transmission channel, I would say, and cascading this green agenda, EU taxonomy agenda to the real sector economy and the all individuals in one economy. And the last but not least is monitoring and disclosure. And when we are talking about the strategy and the governance, this is something what I think all banks already started, because the EBA guidelines in terms of the green financing and ESG started in 2020. And we all have the deadline by 2024, I would say, to align our, not only the strategies and the internal acts, but also our operations with all this, what is in the agenda. And because of that, I think that the banks are more advanced compared to other sectors, and we have this capacity to cascading and downstreaming to the others. So for the banks means that we all in our strategy are already dedicated toward adopting and implementing the standard principles, I would say, and the requirements which are related to the ESG topic, but not only that, but also to cascade it to all, I would say, operational level and decision-making level, which is very important if you want something to enforce and to downstream. It's not just to prescribe you in the documents. You need, I would say, first to enable the framework how to secure that it will be implemented, because through the implementation you will then broaden the mindset of the overall organization, and especially, let's say, our clients, because these are our key stakeholders. When we are talking about, and this is also very important, because this communication with the clients, especially with the SME, I would put the focus for the SME sector, because large corporate clients already has, I would say, ESG topic on their agenda, and they have higher capacity to implement it. But the small and medium-sized sector, which I think most of the economies in the EU rally on this sector, and in Serbia is also the same situation, doesn't have enough capacities, knowledge, infrastructure, and I would say capital to start implementation. And even I would say the mindset about what does it mean and what is expected, I would say, from their side. The second I mentioned area is the banking operation, and these most important banking operations are operations toward the clients, and especially loan approval process, because this is something where we are, I would say, starting communication, and through which we can somehow cascade all the principles, standards, and requirements to the real sector of the economy. And this will be demanding, this will be something new, because related for this ESG topic, we will have the different rating model, which will then, the clients who are more dedicated toward the green financing, or the decreasing of the environment pollution, or the protection from the climate, I would say, or the minimizing effect of the climate changes, they will have the better rating. So they will have then the lower cost of funding, and this is something how we can impose further, I would say, dissemination of this topic to be built in the agenda of these, I would say, companies. The last one, but not least, is monitoring and disclosure, which is very important for us, and this is the responsibility, I would say, of the banks. The responsibility in a way that, as I said, 2024 is the year and the deadline when we need all the banks and the financial sector needs to be aligned with these requirements, standards, and principles related to ESG, which is again aligned with 2050 as a deadline when, according to the EU taxonomy, Europe should be a fully carbon neutral, I would say, continent. So from that perspective, there is a set of indicators which are defined, which should express how, to what level of transition and the physical risk bank implemented already and is ready to implement, because then it will influence other regulatory requirements, capital adequacy, MREL requirements, I don't know, coverage requirements, which are typical, I would say, regulatory requirements for the bank. And if the bank is better, I would say, in minimizing this transitional and I would say physical risk, then other regulatory requirements will be better for us. So all these, I just try to illustrate and to put some, I would say, specific and concrete steps what is expected from the banks and what we already did 3 years in the past, and we have still year and a half to finalize the process required from the bank. Dedicated resources, continuous, I would say, investment in the people knowledge, increasing the know-how, and what is the most important is, I would say, transferring this knowledge to our clients, and in this way disseminating and downstreaming to the real sector.
First, we'll move on to Ivan. Tell us a little bit about investor sentiment around all of this. What is the appetite like? And regarding pricing, is there still a greenium attached to it?
Thank you, Courtney. So certainly investor sentiment has been growing since 2015. Sustainability definitely is not an alternative asset class. We have some investors that have actually a limit that they can only invest up to 10% in the banks that are not ESG compliant rated. So it's clearly something that no bank can afford not to be part of the journey. We just started actually this week on Tuesday we had the first sustainability investor call, so it's not anymore pure financial results. Even in strategy, I'm spending more and more time on sustainability. We implemented a quite broad program in the last 2 years, and what we see and what we get, actually, we get bombarded by investor questions, questionnaires, ad hoc calls. How do we approach sustainability? Basically, I prefer sustainability than ESG, a stack of letters, because ESG is missing one. E is the economic sustainability. A company needs to be creating value over time, not solely focus. But where we lag behind in this region is the G part, and there is too much money in the world chasing too few sustainability projects. If you define inflation that way, we have sustainability inflation that in the region here we don't have adequate governance practices, I think Matteo mentioned it earlier, to utilize the funds. So if we talk about the financing part, most of the green bonds are oversubscribed 3 to 4 times. We see some of the governments of the neighboring countries, Austria just last week raised 3 billion 5-year bond. Actually, they're trying to build a yield curve on green bond. And on the premium itself, there is empirical evidence. It's just starting. It will take time to get to the statistically significant data. It's around 3 to 4 basis point, but with the investors around the world willing to support sustainability projects, I guess this premium will increase. Then, I've just been 2 weeks ago in Singapore with one of the largest funds. I'm surprised how much they know about our region. They know country specifics, and they are willing to invest, but they are looking for this kind of investor confidence that their money will not be used for different purposes. So that's why they're looking us at every aspect. They look basically whether I print, they look how much we achieved. Let's say in last year we halved our carbon footprint by almost 50%, halved paper consumption. But it's quite incredible what level of detail they're looking. What do you do as a bank? And how will you support that green, not only green, sustainable transition? So in our group, we decided that sustainability is a foundation, basically, of our strategy, and we are willing to share it with all the banks. How do we approach it when it comes to framework, when it comes to net zero strategy? Everything is online. We are publishing our sustainability report, and we are actually willing to cooperate with other banks to finance the transition.
That's great, and I think something that we will want to get into in this discussion is the aspect of collaboration in the industry. How much is there, and is there a need for more of that, perhaps working groups around it? I'll turn to Caroline first, though. From the perspective of international investors, tell us a bit about the importance of the ESG standards from the perspective of IFC in terms of where and how you invest, and a little bit of detail about the standards and the corporate governance methodology that IFC has in place.
Thank you. Yes, delighted to. Very, very happy to be here. So just so everyone knows, IFC is part of the World Bank Group, and we are the largest development finance institution globally because we work globally. So I think that's important to understand because we do look at ESG in every single investment that we make everywhere in the world. And we use the same standards, same methodology globally. And our standards for ES and G have been adopted, or similar standards, by almost every other development finance institution, the Equator Principles banks. I heard someone earlier talking about PRI. We've also got the Principles for Responsible Banking. And we all follow more or less the same standards when we're looking at ESG. And I think it's really important just to reflect on that and how much money, as we've just heard from our other panelists, is really looking at these E, S, and G aspects when they're making their investment decisions. My personal opinion is that this will become, all investment decisions will be based on these requirements. Our performance standards are our environmental and social standards. They've been around for over 20 years. As has our corporate governance methodology, and I was interested to hear that you think that's an area that needs more work. I would agree, especially in this region. And I have to say, they're all publicly available. So if you want to go and see what it is we're looking at, you know, it's all there. We're very transparent on what our requirements are and what we're looking at when we're making investments. But a really important point I'd like to bring in at this early stage is, when we're talking about sustainable finance, we're really looking at two sides of the same coin. You've got a sustainable finance opportunity, and you've got ESG risk management. And they have to go together. But this is partly where I think some of the confusion has come in with all of these various different acronyms. What does ESG mean? What is sustainability? ESG was originally coined back in 2004 by a report where IFC contributed, the Swiss, UNEP FI, and several other banks, because we, at that stage in 2004, were saying, this is what we should be looking at when we're making an investment. We can't just look at, you know, what is the net present value and what's the IRR and are we going to make some money? But we want to make sure that we are not causing harm to stakeholders, we're not causing environmental harm, and we have good governance practices that enable good environmental and social practices. And we heard earlier about the EU taxonomy, which has its do no significant harm requirements. And this is really where ESG as a term came from. Now it's kind of morphed into this sustainability area, which is also the opportunity, the decarbonization, the energy efficiency investments. And really, this should be looked at holistically. I also prefer the term sustainability for that reason, because we've got both an opportunity and risk management aspects that need to come together and really can unlock a huge amount of investment in this region in particular, because as we've heard, we have all this regulation coming in from the EU on the previous panel. It's going to hit this region in the next few years, and it's going to hit not just the banks through SFDR, but it's going to hit the businesses and all the supply chain that's going into Europe. So everyone has to be doing it. And so this is why I really want to emphasize both the opportunity and the risk management angle of the ESG standards that we are all looking at. Thank you.
Thank you very much. I'll return to Galić. Something you mentioned a bit in your initial remarks was about spreading the ESG culture kind of throughout the chain to your stakeholders. Can you elaborate on how to do that, but also maybe speak to how you see the educational role of banks more generally and how that can apply, I guess, throughout society even.
Yes. Jelena also partially covered this subject, but I would just go a bit further on that. So I think, of course, bankings, since they are reaching out to a very large scale in the economy, has this kind of responsibility of leading by example. When we discuss the ESG requirements, disclosure requirements, sustainability reports, and all other aspects, I think it's very important that the banks themselves first establish a high level of transparency, and then representing this in a credible manner to all its clients. What does it mean? First of all, in-house, I think the banks should have a clear embeddedness of the ESG framework. First of all, it should have all the banks should have clear corporate values, preferably incorporating some of those. It should have a clear strategy communicated in all of its reports and disclosures. Then it should act in line with that, and so the disclosures should prove that. And in-house internal governance should also reflect that transparency, meaning that all the internal stakeholders are properly informed by about the strategy, about the risk appetite framework, about the risk appetite statement. And as much as possible, I think in Western, Central Eastern Europe or in the Western Balkans, it's very important to shift a bit towards the quantification of ESG risk, because so far we have been talking about this subject quite a lot, but majority of the discussions, even in the disclosures, are fairly qualitative. So we should ensure, of course, that the pillars are available for that facilitating that. So quality assurance in terms of data provision, clear definitions are properly understandable for everyone. We heard about the IFC. There are different taxonomies that different institutions apply. EU taxonomy, CDI taxonomy, IFC and other IFI taxonomies. So we first have to be clear on what we are applying, because exclusion lists and a couple of other items or underwriting processes are more or less clear apart from maybe the models that we are applying. But this part, which taxonomies do we apply and that communicating it to the clients is very important. And when it comes to after establishing the internal transparency and the internal governance that meets all these criteria, then it comes to our clients. I think banks have maybe twofold task in this. One is establishing, similarly to the financial literacy that most of the banks, I believe, play a very important role in spreading the wider range of financial literacy in the economy, both in private individuals and in legal entity segments. The same should follow for the ESG. So, as Jelena mentioned, providing advisory function to some of our clients which doesn't have the capacity to build up properly their ESG strategies, doesn't understand clearly what does it mean, or to create all the framework around it in order to be able to provide reliable and equally measurable data to the banks, granular data to the banks, that later on the banks can rely on when it comes to regulatory reporting. So this kind of education, I think, is very important from the bank side. But on top of that, I would just emphasize, this is not the educational purpose, but regarding the assessment of investments. So similarly, as the investments are assessed not just based on MPV and IRR models or IRR calculations, but also on ESG aspects. From the bank perspective, that should be clearly communicated to the clients what additional expectations compared to a normal risk assessment we are putting or setting forth to them. And I would just highlight one potential threat. When it comes to measuring the region, I would go back to my initial statement about objectively measurable definitions such as, I don't know, capital adequacy or liquidity. So in terms of the ESG factors, or particularly the environmental factor of that, we have heard in the previous panel discussions that coal is the next one on the edge of being close to the exclusion list. I think we should bear in mind that changing an energy mix of a country is an enormous amount of capital expenditure it requires. So why I'm mentioning it, because it's part of the transition and communication with our clients. But in the region, we talk about probably few terawatts of built-in capacities in the power industry. So changing a significant part of it, it would require several, if not dozens of billions of euros raised either through equity to a smaller portion and to a larger portion through debt financing. That requires a strong participation, and that's why when I'm connecting it with the wider range of educational roles, so it cannot be established only by the banks. The legislative environment should facilitate that as well, that banks can properly communicate their requirements and needs to the clients, so that what I mean by legislative environment is that the legislator establishes a framework where still those investments are worthwhile doing, both for the investors and for the banks to be eligible for financing. That's it.
Thank you very much. I wonder, Caroline, would you like to briefly address the issue of standardization that Balázs has mentioned, and this is a topic that comes up a lot.
Yeah, and let me differentiate between taxonomies and ESG, because they're not the same, right? Taxonomies, let's look at that word. What does it mean? I'm English. It means a list. That's what taxonomy means, right, guys? It's a list of what you can invest in. We don't actually have a taxonomy in IFC. We invest in a huge variety of different things. We have an exclusion list, absolutely. Coal is there already. And we're exiting from all fossil fuels. But taxonomies, the taxonomy is trying to address this problem of standardization and what counts as sustainable finance. It's the opportunity side. Look, there's a lot of debate about taxonomies. I don't want to go there, but I think they can add value in that it can help with this standardization, and this fits this box of sustainability, which is one thing. But I think, frankly, more importantly, is the risk management side, and that we are not going to just invest in this because it ticks this box and it's nuclear, so it's fine, right? Well, maybe it isn't fine, And actually, maybe this wind farm isn't fine. Yes, it's great. It's renewable energy. We're going to have all of this wind power. But what about the bats and birds that it might be killing, right? There are ways to mitigate those risks, and that's where I think we do need to differentiate between the opportunity and the risk management. And I'll come to one of my favorite topics, which is greenwashing, because I feel that there's a huge risk for all of us when we talk about sustainable finance from greenwashing. And I'm sure everybody in the room is aware of the various debates going on globally about greenwashing, and in particular in the US about the term ESG, right? So let's make sure that when we talk about things, we're clear on our terms, we know what we're talking about, and that we don't kind of pretend that just because it fits a list, that it's necessarily a good green investment, because there's a whole bunch of other risks that we need to be looking at. And we need to be looking at those E, S, and G risks in quite a comprehensive manner to make sure that our overall investment is sustainable, right? And is net contributing to where we're trying to go. There's always going to be some sort of negative impact. You've got to manage those risks. You've got to understand your level of appetite. But what I'm seeing a lot of, and one of the reasons why SFDR, the Sustainable Finance Directive, has come in is to try and avoid this greenwashing because of the lack of terminology about what counts as a sustainable investment. So yes, that's the taxonomy, SFDR, but I think we should all get behind managing the ESG risks and looking at those impacts and trying to mitigate them. You know, I don't want to stop business. I'm very pro-business. When you build a factory, you're going to have emissions, and we haven't got to net zero yet, and we haven't figured out how to completely avoid all of these things. You're going to have some impact on the environment. You're going to have some impact on your neighbors, on the people who live near your factory. You're going to have some negative impacts. So it's not just about, I don't care, I'm going to make money. It's about, no, I'm going to make money. I want to make money. Profit is important. But I want to do it in a responsible and sustainable way. So how do I manage those possible impacts on the river next door, on the people who live down the road, right? How do I manage those risks? And that's where ESG standards come in. And as I say, IFC standards, they're pretty much the same as all the development finance institutions. We all look at those risks in the same way. And I think that's a really good starting place. Rather than starting with the reporting and starting with the opportunity, because that's where the risk of greenwashing can really come in. Because if you're just reporting on sustainable finance, but you haven't managed the risks behind it, I think there is a very big risk of greenwashing. Thank you.
Thank you very much. There's so many things I would like to pick up on from what all of you have said, but I'm watching the clock a little bit, and so what I'd like to do, I want to be sure that we hear once again from Metodia, Ivan, and Jelena. What I would ask first, beginning with Metodia, give us a little bit of the glimpse of what trends you expect briefly for the future, but also, do you think there is a need for more industry-wide collaboration across the Western Balkans around this topic, and what might that look like, if so?
Yeah, that's a good question. First of all, I mean, there are many pull factors, apart from the push factors, of introducing and implementing ESG. Already the market is requiring, already the investors are requiring, already there is a huge door of opportunity in which I think the companies and the economies is not considering ESG as why, but rather than when to introduce and when to implement. And the trend is given the fact that either from both regulatory perspective or also market opportunities, I see more and more companies and more economies applying ESG standards and looking and thinking about sustainability. Some markets more, some markets less. So I think the train has departed and there is no stopping. The idea is how far do we get on the train, and then how much do we use of this competitive advantage comparing to other economies and other markets. The faster the Western Balkan applies ESG and think about long-term sustainability, the more they become compatible comparing to other markets. And that's why I think that, first of all, getting to know about the topic, cooperation between our markets, because in general, Western Balkan, when we are speaking about, it's not a huge market. It's a very relatively, unfortunately, limited market. So the more there is a cooperation between countries operating as one, the more there is a discussion on the topic or even joint activities in moving or investing for more sustainable projects, I think this would be one of the ways to make Western Balkan as a region more competitive comparing to other regions, because there is no alternative, unfortunately, to this one.
Thank you very much. And Ivan, you mentioned the kind of transparency around what your institution does for the greater good and knowledge sharing. What would this kind of industry-wide collaboration look like to you? What would work?
Let me start first with Carl. I just mentioned that there is a risk of greenwashing, so first of all that we eliminate that, and EU taxonomy is maybe trying to fix a part of that problem to put kind of an order in the classic, let's say, traffic light buckets. There is a red zone, so we don't finance coal for 3 years, that's it, anything correlated. Then there is this yellow bucket, which no one knows exactly where does it belong to. In some countries, nuclear is green, in some not. Then we have this green opportunity that we have seen. I think Galić has shown us the 6 buckets. Is that all? Certainly not. Where we see actually that most of the money will flow, that's actually very correlated with where the carbon is, because net zero is not the target. It's just point in time for any organization. It's just one day. We should continue to net negative. And then there are, I would say there are 5 main opportunities. Green buildings are by far number 1. There's one actually interesting IFC report a few years ago. So there is, I think 48 trillion opportunity, mostly obviously in China. In EU, buildings are consuming 40% of the energy, of the entire energy, or just a little bit short of 40% of the CO2. So obviously that's a big bucket when investment management companies do their strategic asset allocation. Obviously that part has to be dominant. Then the second opportunity are renewables, energy production. The third one is the energy efficiency. So retrofits actually on buildings, on old buildings in Europe, in our region, are something that we should jointly finance. Then I would say fourth one, only at the fourth place. A lot of people talk about electric cars, but in terms of the opportunity, they come only at fourth. And the fifth one is, in our region, is definitely forestry and agriculture, and then all the rest comes. So we are happy actually to do the syndicate placements, bilateral, I mean, all for the good of the region and on the planet. We have a small share of the world to play, and look at this beautiful country around. When you fly to Tivat, there are 2 dominant colors, green and blue. So let's keep it that way.
That's quite an inspiring way to look at it. Jelena, any reflections you have, first of all, on what you've heard from your colleagues here, and final thoughts you'd like to leave us with?
Yes, yes, it was very interesting, I would say, and I fully agree with Caroline, what she said, that, okay, these are not just the list and just the taxonomy. We need to make the difference between the terminology, but the point is how we really, in the essential way, are measuring this and have the approach to this. But on the other side, I think banks are regulated institutions, and this is something which I think a lot of these requirements, regulatory requirements, what we have should, I would say, somehow enable that this greenwashing and some other risks, which obviously this is the evolving path, so it's obviously it will be on the scene at some point, maybe at early stages, I would say, should enable us somehow faster to overcome these child diseases, and I would say, and really essentially to have the broad mindset of all stakeholders, and I would say each individual how to approach. So this is something what, let's say, I would like to stress. And the second point, maybe what I have, I would say, impression is for I don't know how many years in the past we all talks, I would say, about the ESG taxonomy or whatever, but I think that soon rather than later, it's realistic that even each individual and the real sector of the economy, which is still somewhere behind, will be oriented toward this, not only because of the regulatory requirements, not only because the banks will push them if they want to have the finance or whatever to raise the funds for financing their project or the business, but because I would say, again, the market pressure, because there is a different, I would say, profile of the customers, especially with the younger generation who will not buy and use any product which are not, I would say, has the component of the ESG, pollution protection and whatever. So from that perspective, the customer preferences will influence that the market profile will change, and this will be the natural, I would say, elements or the driver how to boost, if I can say, or have more dynamic implementation of all this.
Thank you very much. There's a lot more that we could probably get into, but we shall leave it there. I want to say a big thank you to all the panelists for sharing your insights and expertise. You were really excellent, and I hope set the stage for maybe discussions on some of these topics throughout the rest of the summit. Thank you.